For a long time, the movement was so gradual that it barely registered. Contracts were renewed as usual. Trade invoices still arrived denominated in familiar terms. Treasury auctions continued to clear. From the outside, the machinery of the global financial system appeared intact, humming along with the same quiet efficiency it had for decades. Yet, beneath that surface, something subtle had begun to change. Not in the language of speeches or headlines, but in balance sheets, settlement practices, and the small decisions made by institutions that rarely announce themselves. These shifts did not feel dramatic because they were not designed to be. They were administrative, technical, almost boring. That is often how structural change begins. When historians look back at monetary transitions, they rarely find a single decisive moment where one currency lost and another won. Instead, they uncover a long period of quiet adjustment in which actors began behaving differently long before anyone agreed on what it meant. The change first appears not as a crisis, but as a preference for optionality, a preference for insulation, a preference for not being too exposed to a system that, while still dominant, has grown less predictable. In the present case, the preference has been expressed through a steady redirection of reserves, trade settlements, and long-term planning away from a single monetary center. For years, China accumulated dollar assets as a matter of necessity rather than ideology. The post-war financial order made this almost unavoidable for any export-driven economy operating at scale. Dollars were the lubricant of trade, the unit of account for commodities, the anchor for reserves. Participation required compliance. Over time, this accumulation became immense, measured in the trillions, and it tied China's financial fate to the stability and policy choices of another country. As long as the system felt symmetrical and durable, this arrangement was tolerable. The risk was abstract, theoretical, something discussed in academic papers rather than internal memoranda. What has changed is not a declaration of hostility or a sudden rejection of the dollar's role, but a reassessment of vulnerability. Systems that last a long time tend to produce confidence not just in their strength, but in their permanence. That confidence seeps into forecasts, models, and assumptions. It becomes embedded. Yet permanence is not the same as resilience. A system can endure for decades while slowly accumulating stresses that are invisible to those who benefit most from its continuation. When incentives shift, even slightly, behavior follows. The earliest signs of this reassessment appeared in places few people watch closely. Bilateral trade agreements began to experiment with alternative settlement currencies. Central bank reserve reports showed incremental changes that, on their own, looked insignificant. Gold purchases increased without fanfare. New payment infrastructure was developed in parallel with existing systems, not to replace them outright, but to ensure redundancy. None of this required a public confrontation. It required only patience and a long memory of how power is exercised through finance. From the perspective of the dollar-based system, these changes were easy to dismiss. The scale of dollar usage remained overwhelming. Markets were deep, liquid, and trusted. Legal frameworks were familiar. The alternatives appeared fragmented and untested. Analysts pointed out correctly that no other currency offered the same combination of openness, depth, and institutional credibility. All of this was true. It is still largely true. But structural shifts do not need to overturn a system to weaken it. They only need to reduce its exclusivity. History shows that dominant monetary systems begin to lose influence, not when they collapse, but when they cease to be the only option. The loss is relative, not absolute. In such periods, the incumbent currency continues to function, sometimes very well, even as its marginal role in new arrangements declines. The danger lies in misinterpreting continued usage as continued centrality. These are not the same thing. A currency can remain widely used while its strategic leverage erodes. China's position in this process is unusual because of scale. Small countries diversifying reserves do not alter the architecture of the system. Large ones do. When an economy of sufficient size decides that concentration risk is unacceptable, its actions ripple outward. Suppliers adjust. Counterparties adapt. Financial institutions build new capabilities to meet emerging demand. Over time, what began as a defensive measure becomes normalized behavior. The system bends without breaking, which makes the transformation harder to perceive. This is why the shift matters more than it appears. It is not about an imminent replacement replacement of the dollar or a dramatic loss of confidence. It is about the gradual reconfiguration of dependency. The dollar's post-war role was not just to facilitate trade, but to concentrate it, to pull global flows through a single financial center. That concentration created efficiencies, but it also created leverage. As long as participation was universal, that leverage was unquestioned. When participation becomes conditional, even partially, the leverage weakens. Late in the process, political interpretations tend to rush in, assigning intent and motive, where the reality is often more mechanical. Institutions respond to incentives. They manage risk. They hedge exposure. When the perceived cost of dependence rises, diversification follows. This does not require antagonism. It requires only experience. Over the past decade, the use of financial channels as instruments of policy has made that experience tangible for many actors who once considered it hypothetical. At this stage, the system still looks stable. Markets still function. Transactions still clear. The dollar still anchors global finance. That is precisely why the shift can continue without resistance. There is no emergency to rally against, no visible breakdown to fix. The adjustment happens in spreadsheets, not speeches. It happens quietly over years, until one day it becomes clear that the system everyone assumed was fixed has, in fact, been slowly rebalanced. The significance of China's trillion-dollar shift lies here in the cumulative effect of many small decisions taken over a long period of time. It reflects not a sudden loss of faith, but a calculated recognition of fragility in systems that once appeared unassailable. History suggests that by the time such recognition becomes obvious to everyone, it has already reshaped the terrain. The opening phase of that process rarely feels like history being made. It feels like routine. When monetary systems weaken, it is rarely because confidence vanishes overnight. More often, it is because the structure that once made confidence rational begins to change. The pattern repeats across centuries with remarkable consistency. Dominant currencies rise alongside expanding trade networks, deep capital markets, and political stability. They decline not when those features disappear entirely, but when their advantages narrow and their constraints become more visible. The transition unfolds through mechanisms that feel technical rather than dramatic, which is why it is often misunderstood until it is well underway. At the center of this pattern is the difference between usage and dependence. A currency can be widely used without being uniquely necessary. In earlier phases of dominance, the two are indistinguishable. Merchants, states, and banks rely on the same unit of account because alternatives are costly, inefficient, or unsafe. Over time, as the system matures, participants build the capacity to operate differently. They may still choose the dominant currency out of convenience, but the choice itself becomes optional. That shift, subtle as it seems, marks the beginning of structural change. History offers multiple mirrors. In the late 19th century, sterling functioned as the backbone of global trade and finance. It was trusted, liquid, and supported by a vast imperial network. For decades, even as Britain's relative economic position weakened, sterling remained central. Trade continued to be invoiced in it. Reserves continued to be held in it. Observers took this persistence as proof that the system was self-sustaining. Yet, beneath that surface, other centers were quietly building their own financial infrastructure, learning to clear trade and extend credit without routing everything through London. What undermined sterling was not a single shock, but a gradual erosion of exclusivity. As alternatives became viable, dependence declined. Countries still used sterling, but they no longer needed it in the same way. When stress finally arrived, the system lacked the redundancy it once had. The adjustment that followed felt sudden, only because the preparatory phase had been ignored. The same sequence appears in earlier transitions involving Dutch and Spanish monetary influence. The names change, but the mechanics remain. In the present context, China's actions fit squarely within this historical pattern. The shift away from concentrated dollar exposure is not primarily about promoting a rival currency as a universal substitute. It is about reducing vulnerability to a system whose rules can change unilaterally. This distinction matters. Attempts to frame the issue as a contest between currencies miss the deeper point. Structural power in finance comes less from persuasion than from architecture. Whoever designs the pathways through which trade and capital flow holds leverage, even if others continue to use the same unit of account. Mechanically, this plays out through reserve management, settlement systems, and long-term contracts. When reserves are diversified, the marginal demand for any single asset declines. When trade is settled bilaterally in local or alternative units, the volume that must pass through the dominant currency shrinks. Each adjustment on its own is manageable. Together, they change the texture of the system. Liquidity remains, but it becomes more segmented. Influence remains, but it is less absolute. Numbers often obscure this process rather than clarify it. The headline figure of trillions suggests scale, but scale alone does not explain impact. What matters is direction and persistence. A steady, deliberate reallocation signals intent to endure outside the traditional framework. Markets are sensitive to such signals. Even when they do not react immediately, they adapt quietly, pricing in optionality over time. The result is a system that still functions, but with thinner margins of control. Another recurring feature of monetary decline is the lag between cause and recognition. During this lag, experts often point to continued dominance as evidence that concerns are overstated. This is understandable. Systems do not advertise their own fragility. As long as transactions clear and obligations are met, the absence of visible failure is taken as proof of strength. Yet history shows that the most consequential shifts occur precisely during periods of apparent calm. Stability can mask reconfiguration. The use of financial tools as instruments of policy accelerates this dynamic. When access to a system is perceived as conditional, participants rationally seek alternatives, even if those alternatives are less efficient in the short term. Over time, investment flows toward building parallel structures. These structures may initially handle only a fraction of global activity, but their existence changes expectations. Once participants know they can operate outside the dominant system if necessary, the system's leverage diminishes, regardless of how often the option is exercised. China's scale ensures that these adjustments are not isolated. Suppliers, trading partners, and financial institutions respond to incentives created by its choices. New norms form slowly. Contracts are rewritten, clearing mechanisms are tested and refined. The dominant currency remains present throughout this process, which makes it tempting to conclude that nothing fundamental has changed. Yet, the pattern suggests otherwise. Centrality is not preserved by habit alone. It depends on the absence of credible alternatives. What emerges from this mirror is a picture of fragility without collapse. The dollar's position does not need to fail to be weakened. It needs only to share space in a system it once monopolized. That sharing reduces the ability to shape outcomes at the margins, where power is often exercised. The shift is cumulative, not explosive. It advances through compliance departments and treasury offices rather than through markets in panic. By the time these mechanisms become widely acknowledged, they are usually mature. The historical record shows that recognition follows transformation, not the other way around. In this sense, the current moment resembles earlier phases of monetary transition more than their climactic endings. The threat lies not in an imminent break, but in the quiet normalization of a different balance. This is how dominant systems begin to age, still functioning, still trusted, but no longer unquestioned. When monetary systems finally appear to change, the experience is often described as sudden. Exchange rates move, liquidity tightens, and long-standing assumptions are revised in a matter of weeks. Yet, those who study these transitions closely know that the sensation of abruptness is misleading. What feels like a break is usually the moment when a long process becomes visible. The conditions that made the outcome possible were established quietly over years, sometimes decades, through decisions that felt prudent at the time and unremarkable in isolation. This is why the end stages of monetary dominance rarely resemble crises in the conventional sense. There is no single trigger that can be identified in advance, no date circled on a calendar. Instead, there is a growing mismatch between expectations and reality. Participants behave one way while continuing to speak another. Official language emphasizes continuity, while operational behavior reflects adaptation. When the gap between the two becomes too wide, recognition follows, often framed as surprise. In such moments, the human consequences begin to register, not because everyday life changes overnight, but because the buffer that once absorbed shocks has thinned. Credit becomes slightly more expensive. Trade terms become marginally less predictable. Institutions that relied on a single, stable framework find themselves navigating a more fragmented environment. For households and businesses, this manifests not as catastrophe, but as friction. Plans require more contingencies. Long-term commitments feel less certain. The sense of ease that accompanies a widely trusted system gives way to caution. Historically, this phase is where misunderstanding is most common. Observers look for dramatic confirmation and, finding none, conclude that warnings were exaggerated. Yet, the record shows that decline often proceeds through normalization. What once would have been considered exceptional becomes routine. Using multiple settlement currencies, holding reserves in a broader mix of assets, maintaining parallel payment channels, all become standard practice. None of these steps signal collapse. Together, they redefine what stability means. The unpredictability of triggers adds to the illusion of safety because no one can say precisely when or how stress will surface. It is tempting to assume it will not. This logic has appeared repeatedly in past transitions. Prior to earlier monetary realignments, participants acknowledged imbalances, but trusted that existing institutions would manage them indefinitely. They were not entirely wrong. Institutions did manage them until the accumulation of small stresses exceeded the system's capacity to absorb them. What changes in this phase is the distribution of risk. In a highly centralized system, risk is pooled and often invisible. In a more fragmented one, it is dispersed and more directly felt. The shift away from exclusive dollar dependence does not remove risk from the global system. It reallocates it. Some actors gain insulation, others lose predictability. The overall effect is not collapse, but a lowering of the threshold at which disruptions are transmitted to the real economy. For individuals, this can mean living in a world where financial conditions are more sensitive to events that once would have been absorbed quietly. Currency movements matter a bit more. Access to credit depends more on global sentiment. Long-term pricing becomes harder to lock in. These are not dramatic changes, but they accumulate. Over time, they alter behavior, encouraging shorter horizons and greater emphasis on flexibility. The quiet realization that follows is rarely expressed openly. It appears instead in institutional behavior. Policies become more cautious. Commitments include more escape clauses. Growth strategies rely less on assumptions of seamless global integration and more on resilience. This adjustment does not imply failure. It implies recognition. Systems that endure longest are those that adapt early, often without acknowledging why. China's trillion-dollar shift fits into this final phase not as a dramatic act, but as a catalyst for awareness. Its significance lies less in what it immediately disrupts than in what it reveals. It shows that even the largest participants no longer treat the existing monetary order as immutable. That realization, once internalized by others, becomes self-reinforcing. The system continues to function, but it does so with a different psychological foundation. In the end, monetary transitions are remembered not for the years of quiet adjustment that preceded them, but for the moments when their effects could no longer be ignored. Those moments feel sudden because attention finally catches up to reality. By then, the choices that shaped the outcome are already in the past. The story, when told honestly, is one of gradual change and delayed recognition, of stability that persisted just long enough to disguise its own transformation.